Thanks for coming this morning. You've been invited by one of our clients. If you're not a client of ours, we're grateful that you're here. We're going to spend a few minutes here talking about the market and the economy. Y'all want to hear anything about that? Or you just want to take off?
No, let's hear.
Let's hear. So every year we do a kickoff market analysis, and then we do a halftime report. And this is a halftime report unlike any other. It's been a tough 6 months as far as the economy. It's been a tough 6 months health-wise in our country, and it's also been a divisive time in our country. So things are different today. But our firm name is Security First Asset Management. We are retirement income planners. Primarily, that's what we focus on is retirement planning. So that's about all we'll talk about that. Let's just talk about some of the things that are driving our economy today. I'll take the first half of the presentation. I'm going to kind of talk about where we are, where we've been, and Daniel's going to talk about where people think we're going. Now, with that said, we could ask 500 people where the economy is going, they'd all give us a different answer than we give. So, but what we have had is we do have some research, and some people far smarter than we are trying to read what's going into this. And I just want you to understand that the economy is never ever prepared for black swans. Black swan events are things that are catastrophic that happen. We don't want them to happen, but they happen. So the pandemic is a black swan event. The financial crisis of 2008 was a black swan event. Those things just happen. We don't have control over them. Well, in some cases we make bad decisions, but who knows where this came from. All right, so if you got one of them darn things on you, you might want to silence it. Now, remind myself to do the same in case my wife calls. If my wife calls, y'all, it's a song. What's it called?
My best friend.
My best friend. There we go. We don't want to hear that this morning, do we? Okay, if you have questions, again, we're not economists. We're financial advisors. So if you have questions, do ask. If we have an answer, or we'll certainly give it to you. But we want this to be informative. So don't sit there. You may have the same question somebody else has. So don't hesitate. If you have concerns, let's talk about it. We're a full-service financial advisor firm. That's what we do. This is a disclosure. We're not here to sell product or services. We're here to give you information today and have a good time. If you choose to have questions afterwards and want to work with us, that's okay. We welcome that. But right now, this is for a fun time and informational purposes only. So we're going to have a review of the U.S. markets for a few minutes, and then we're going to talk about what fundamentals support the economy and what doesn't. And then Daniel's going to get into the second half outlook and what people are talking about is going to happen moving forward. And that's all speculative, a whole lot have to do. We don't know what this thing's going to do right now with the pandemic anyway. So let's get right into it. This is what this year looks like so far. Isn't that exciting? Well, December 31st of last year, the S&P 500 actually was around 3231. I don't know if you guys track it that close, but that's what it closed at, 3231. And then we kicked off the year pretty good in December. You can see that number. You can't really see it back there. But we're hovering just under the 3,300 in the S&P. Now, what is the S&P 500? Well, it's 500 of the largest stocks in America, 515 or so. And that's kind of what everybody uses as a gauge to whether the economy's doing good or not, right? That's kind of what we use, that and the Dow. But the S&P is trying to drive things more because the S&P is 500 stocks and the Dow is less than 35. So there's a big difference between 500 U.S. large companies and 33. So that's kind of the measurement that everybody uses in the economy to kind of figure out how things are going. So as you can see, we took off in January. It was pretty darn good. It was driven, frankly, by the positive things that were coming out with the trade agreements with China. Let's think about that for a few minutes in hindsight. We can look back, right? Things aren't looking so good right now. But for February and January of this year, they were very, very good. The market actually took off. So February 25, that's when we started February 25th, we started hearing things like, hey, something's going on in China. There's a serious epidemic taking place there, and it hadn't yet reached us. So what happened when it started reaching us? As you can see, February 25th, health officials started to warn that this COVID-19 was serious. And as you can see, things started getting worse and worse. On March 12th, President Trump institutes a European trade ban, travel ban. So now we see it coming forward, and then March 16th, President Trump says the COVID-19 could extend into August. Well, where are we right now? We're in August, but has it slowed down at all right now? Not quite, has it? Now, what happened when he made those remarks, things started looking better. Positive results started coming in from some of the clinical trials. Some of that has been discounted now, by the way. And as we can see, typically in the market, if you have a 30, 35-point drawdown like we did, which is the worst one, by the way, people look back and say, well, 2019, 2020, 18, 1929, 1932 were worse. They weren't. We sold off 33 points in 21 days. 33% in 21 days. That's the worst in history. 29 and 32 were right behind it, 22 to 25 days. So we went through something that we've never done before in our financial markets. Most of the time, these recoveries are kind of like a U-shape. They come down and then they come back up like that, right? Well, does that look like a U or a V? That's a V. But the bad news is it's a V as we'll see later, it's a V, but we don't have a lot to substantiate that it ought to be there. Okay? That's the bad news. So on June 25th, the S&P was back to 3075. So we started the year at 32. We're back to 3075. Remarkable. Yesterday it closed at 3271. 1 point below December 31st of 19. That's crazy. That's good for all of us that experienced the good part of it, right? We're kind of getting back to where we were. So I'm not sure that we're out of the woods yet, and I'll show you why. Now, every year in December, all these talking heads, as a matter of fact, I went to an economic summit in December of last year in New York City and got to go and participate in ringing closing bell. You don't get to do much of that anymore. It used to be open to the public, now it's invitation only. And I was in meetings with 4 of the leading economists in America, and nobody talked about COVID because nobody really knew anything about it. This is like the first week of December. But anyway, all these guys were given these kind of numbers here. Everybody had a number. So the media puts together all these talking points. What's the economy going to be like in 2020? Well, these guys were talking not only 2020, but most of them were looking out the next 10 years. And some of the news was not all that promising for long-term growth. But you can see the numbers. These are big firms. Morgan Stanley said that we'd have a 3,000 at the end of 2020. We're already past that. We're at 3271, right? But you see a 3,000 is about the low number, isn't it? The high number is 3425. Well, we haven't been there. I don't know if we're going to get there. But it said for a 2020 average, 3272, we closed on Friday at 3271. But it's not December 31st, right? So we're not necessarily going to get there. If we stay the same, that'll be great. So despite what has happened, we've had a remarkable recovery thus far in the markets. So what drove all this? Let's go back to be able to understand it. Let's go back to 2010. These are the leading economic and financial indicators. If we go back to January 2010, out of all those indicators, there's 20 of them up there. There were, how many are green? You can see it. 17 of the 20 are green and 3 are caution. So what was happening in 2010? We were coming out of the 2018 financial crisis. So things were looking very positive across all the economic indicators. You're talking about financial markets, disposable income, construction, interest rates, etc. Those are the indicators up there. So this is 2010. So that was after a major downturn in the market. So let's go ahead to January of 2020, before COVID-19. Now there's still 20 leading indicators there, but only, how many are green? Who can see it? 10. There's 10 green. Is there any red on there?
2.
Yes, there's 2. What are they? Geopolitical risk, political risk, and political environment. Woo! That was in January, right? I bet that number of the day would be a little different, so let's see. June of 2020. Folks, these are leading indicators. What that means is if these things are turning into yellow or red, the economy is forecasting to be something different than it is today. Okay? So now we look ahead here, just last week, and how many green are there? 4. How many reds? There's 7 reds. So 7 out of 20 is what percent? To make quick math. 35? Thereabouts? So based off the leading economic indicators, what's driving this is we don't know. We don't know how well companies are going to do in the next few months. We have no idea. Stock prices are valued based on profits, and have y'all been paying attention to any of the profit reports? Just think about it. If we shut down the economy, we've got, what, 17 million people not working. So we're not looking as good today as we did in December of last year or January. So we ought to be thinking about what we can do to protect our assets instead of being wide open in a market that's had a whipsaw. So what did the Fed do? Well, they learned some lessons from 08. In 08, they didn't react quickly enough to stimulate the economy. This time around, they reacted really quick. Within 8 days, they had the payroll protection plan in place for small businesses. That's crazy. The government never moves that fast. Now, since then, they've revamped the program and all the other stuff associated with reporting, but they got it done. And they sent out the stimulus checks. And they did something with that ended also on Friday, the unemployment compensation of $600 a week. There's people actually taking home more money now than when they were working. So this thing is, I'm sure the House and the Senate are working this weekend, right? So that means somebody's not going to get a paycheck next Friday, doesn't it? So I don't know about you, but if you stop to think about the millions of people that have been drawing unemployment and that check stops, what's that going to do to the economy? So it's in the government's best interest to keep the money coming. They just can't agree upon what to do about it, right? So here's how the Fed intervened. March 15, it cut the federal funds rate to 0. Folks, that's good for borrowers. It's terrible for savers, right? Can't make any money on that money. QE, at least 700 billion, creation of commercial paper funding. These are all the things they did in a very, very quick time frame, about 3 to 4 weeks. And then in June 8th, they expand the Main Street lending facility. So they've got lots of paper they're putting on the street. They're printing a lot of money. And they're probably going to have to continue to print money. Now, long term, that probably doesn't affect you and I, but I worry about my kids and my grandkids, right? Because somebody's going to have to pay this debt. And folks, frankly, it's in the best interest of the government to keep interest rates at low numbers so they can service this enormous debt. So think about that if you're dealing with fixed income bonds and or interest rates. I mean, if you don't earn much on that, how's that going to impact your ability to spend money if you need that income? So it's a rock and a hard place, and we're not out of it quite yet. I think it's your turn.
It is my turn.
So this is where we are. He's going to bring some exciting news about where we're going, right?
I hope so.
Any questions so far? Pretty logical? It's real. Okay.
Does anybody have any questions about what may be happening in the future and any particular things you want me to cover? I'm going to be talking about the outlook. A couple of different things I'm going to hit on are still some things that we've been going through. Speak up if you have any questions for me. So what we're looking at now, some of these charts are unbelievable. It's never been seen, the amount of unemployment that has dropped, the amount of debt, everything is historic levels. What you're looking at here is the forward 12-month earnings per share forecast versus the current market price. It's hard to see, but the red line here at the end drops straight down, and the blue line, the price is shot straight up. Now, how is it possible with prices of stocks and earnings of stocks to go through the bottom, but stock prices to go up? Anybody have a guess? The government injected money into the economy. For the first time ever, in the second quarter of this year, the government put more money into the economy than was created by the gross domestic product. More money was injected and printed by the Federal Reserve into the economy than was produced in the U.S. economy. That concerns me. Does that concern anyone else? I don't think that's long-term sustainable. They call it the Great Debasement. We're debasing our currency. We've created $6 trillion in money in extra debt. And there's countries around the world that don't like that. They don't think it's fair. They don't want it to be the world reserve currency moving forward. So there may be a consequence down the road to this money printing. And that's truly what it is. They can push a button on a keyboard at the Federal Reserve and create new assets. But they're buying individual stocks and bonds and propping up companies, picking winners and losers ultimately. So that's driven stock prices up because they've committed to unprecedented things to prop up the economy. So we'll see how long it works, right? So far, they have propped up stock prices. So looking forward, typically the price to earnings ratio on the S&P, that's how many multiples you pay for a stock versus its earnings. The average is from 13 to 15. But now it's 23. PE ratio is 23. What you see here is the inflation rate. Headline CPI is a basket of commodities that the U.S. government uses that excludes food and energy. We have very low inflation. Their target is 2%. They want 2% inflation. Their theory behind this is if they can keep prices going up, people will buy more today, and we have a consumer spending economy. Now, to me, a better economy is based off productivity and savings than consumer spending and debt, right? But inflation is in check. They actually want it a little higher than what it is. Their target is 2%. And right now, in May of 2020, core CPI, which includes food and energy, is 1.2%, and headline is 0.1%. Food actually has had a 4% inflation rate. Everybody notice the food prices going up? Yeah, across the country, that's been around 4%. I expect that. The food cost and production and all that, transportation of food has led to some of those types of things. I was going to mention energy as negative 18. We've seen huge drop in energy prices, especially oil and gas, not so much in natural gas. So unemployment, April of 2020 was 14.7%. We had the lowest unemployment rate prior to that in 90 years, and now we have the highest in over 50 years, of course. So that actually is dropping. It's down to 13.2% today, and they're thinking by the end of the year it'll be around 9%. So we're seeing employment starting to come back. Who knows what the elections, if there would be a national policy, a national shutdown at a high level. That is a concern. If they decide to implement a national economic shutdown, that will change all of this. And it's certainly a possibility. They've done it in other countries. They did not take a national policy here. I'm more in favor of local areas and states.
Yeah, what do you mean by a national?
Other countries have locked down businesses across the country from a national level.
Over COVID?
Yeah, over COVID, yeah, to help spread slow the spread of it. So let's hope that doesn't happen here, but it's certainly a possibility. So that's something we watch. But unemployment rate and wages, it's interesting that the gray line on the top is the unemployment rate. As you see, when it's high, like in October 2009, wage growth is low. It makes sense, right? Yes.
Yeah, what about all the people that are not working because they're making more, get the government check the market?
Well, I read
Is there
that.
going to be a huge jump back in employment when that stops?
I don't know. I think we're seeing an increase in employment. I know part of the legislation they're working on, instead of giving people 100% of their employment wages, they want to cut it to 70.
Right.
Because it is a disincentive. Why would you go to work if you could make more money at home?
Yeah, I mean, my
It
son's
doesn't.
going to get people to come back to work because of that.
Right? I think
They
you're
opened up,
absolutely
They could
right.
come back to work, they chose not to.
Yeah, you got to have an incentive to go do work. If you can just
Right.
make the same money at home, then why would you go?
Shouldn't that make the blue line go up then because they're making more money at the house?
Right.
Yeah, the wage growth, that would just count as unemployment.
I understand, but I mean, it seems like if they're making more money on, and I get what that means.
Yeah.
But I'm saying if they're making more money at the house, but we run into this in our business.
Mhm.
I got friends, I got peers that can't do their jobs because their people ain't coming back to work because they're sitting at the house making more
Absolutely.
money.
Yeah, the unemployment rate will go down if they cut the amount they're giving the business, giving the individuals.
Right.
And I think that makes sense. Why would you pay someone the same or more to stay home? So the other big thing too is as unemployment goes down, it has an inverse relationship to wages. So like when there's high unemployment, wages are down. But when unemployment drops, wages go up because it's supply and demand. All right, now what we're looking at is something called the Consumer Sentiment Index. Every couple of months, the University of Michigan polls 500 random people in the United States and asks them how they feel about the economy. As you can see, it was pretty good here until this year, and then a drop straight down. Do y'all feel good about the economy yet? Just in this room, who feels good about it? Raise your hand. Who feels negative about
I do, Trump get reelected.
it? Right?
All right.
I'm kind of neutral on it. It's hard to say how people are going to respond. The big unknown is we're still learning about this virus and how it impacts people, how it'll work out with schools reopening. A lot of question marks, right? I think the key is individual freedom. I think people need to have the ability to make their own choices, whether or not to operate their business or not. I think that's important in a free country, right? All right, so existing home sales have fallen off the ledge. They've dropped dramatically. Now, every real estate market's different. Around here, the real estate market hasn't been hit as much as other parts of the country. So existing home sales are a lagging indicator. Interest rate policy generally drives home sales, and we see historic interest rates extremely low. And those are projected to stay low through at least 2022. So now's a good time to refinance. Yes, sir.
We have to be very careful in middle Georgia, especially when we're on Houston County, because we're in a bubble. I mean, we've been in a bubble forever. We were in a bubble really in 08, 09, 10.
Oh, yeah.
We really don't understand what the rest of the country goes through 6 sitting in where we are right now.
Yeah,
You know,
a
where
lot
we
of it's the
are.
military
Yeah,
spending.
it's big.
Yeah.
It really is.
So existing home sales are down, and rates are a good time to refinance. They're going to stay low like this for quite a while, so that's something to keep in mind. Now this, to me, is a bright spot in all this. If you look at the peak of the market in 2007, the debt serviced by U.S. consumers as a percentage of their income, 13.2% of their income was going to pay their debt servicing, right? The interest on the debt, their debt. Now that's down to 9.7. That really surprises me, right? It's good. We need a lower debt level at a household level. We have a debt problem in Western civilization, right? So on an individual level, we're doing a better job, believe it or not, than the government at keeping our debt levels low. So that's a bright spot. If you have savings, it gives you the ability to withstand and weather the storm. We have less than a 5% savings rate, average person in the United States. Do y'all know what they have in China, in Asia, what the savings rate of the average person is? Over 30%. They make less money and save 30% of their income. So we have a spending problem here. A lot of that's perpetuated by policy. We want people to spend money endlessly, right? to drive markets. But it's good to have a low debt level. We want to keep debt levels low. So to me, that's a bright spot there. So we've seen a lot of headlines, and everything right now is dictated by where COVID-19 goes and how we're going to handle it, when the vaccine is going to be rolled out, what kind of effects that will have on markets. That is the big factor right now, as everyone knows. So just looking out at the second half of the year, what to expect for the rest of the year. This is the target price of the S&P on the top, and the bottom is the closing price. So, you know, we still have some potential upside compared to the target. Now, I think personally, everything is going to be driven here forward by earnings improvement, quarter-over-quarter earnings improvement. We're not going to get back to the same GDP level, like $22 trillion is the amount of U.S. GDP, probably for 4 or 5 years, if we're lucky. But what markets are looking at is quarter-over-quarter improvement. Right now we're seeing that, so that's helping stabilize markets along with the Fed's policy actions. But that's going to be the key moving forward is quarter-over-quarter improvement, knowing we're getting back to that level. So that should keep markets more stable. Forecasts for market growth aren't huge. Even without COVID, there was only a 4 to 5% target growth over the next 10 years for most economists looking at over the next 10 years in the U.S. markets. So GDP, change in real GDP. The blue line on the left is the actual, and over to the right is the median projection. So this year, the median projection is between -6% and -8% GDP loss to the U.S. Makes negative growth, right? That's bad. But next year, because of pent-up demand, if we truly can find a way around this, find a way to treat it, see improvement, have a vaccine, any of those things, then there's going to be pent-up demand. People are going to return to more normal economic activity. And so GDP growth for next year is median projections over 4%. So that's great news. It would be fantastic if we could see 4% GDP growth next year. It means people are working, they're able to go out, enjoy themselves, buy things. So we'll see if that materializes. Corporate profits fell off a cliff. You can see there, largest drop ever in history. So we really, that's what we're watching, is corporate profit improvement. We've already tried to insulate our portfolio. We like individual blue chip stocks. We've eliminated positions that have broad exposure to China. We don't want to have companies that produce most of their products in China. We see that as a risk. So we've eliminated some of those companies just because of tensions. Trade tensions are heating up. Currency war is starting. If you understand what that is, China wants to be the world reserve currency with the yuan that they have with their currency. And so they've done all kinds of things to make that happen. Number one is they're buying a lot of gold, so they're seen as a safe haven. We don't want that. It would be a negative consequence for the U.S. if we were no longer the world reserve currency, which happened after World War II. So we have to think about that moving forward. So interest rates, they just announced a few days ago, are going to stay unchanged. They're not going to change any interest rates. They're going to stay where they're at now. But we have a few more meetings this year, the Fed, September, November, and December. So as you know, the Treasury yields have dropped way down. So we have the lowest yields ever. So buying bonds when prices and yields are low, if prices rise, or if yields rise, prices fall. So if you buy a bunch of Treasury bonds right now and then interest rates go up, you're going to get hit on your bond prices. We're not big fans of bonds. We do hold them as temporary measures in some circumstances. If you keep real short duration, that's your only hope there. So I think the key is to stay focused on fundamentals. We like companies that have dividend history, 25 to 50 years, earnings increases every 7 out of the last 12 years. Blue chip stocks, big tried and true companies that stay focused on the fundamentals and the growth. The tech sector has fared much better in this. Any exposure like to Amazon and Apple, those types of companies have done very well because everybody's moving online, right? Everybody's looking at the online purchases. So you want to look at companies' fundamentals whenever you're buying them. And also stay focused on your plan. 90% of people don't have a financial plan. They have savings and investments, but they don't have a plan that shows how much risks they should be taking, where they should be invested at, where to take income from, how to keep your taxes low. These things should be a part of a financial plan, and that's what we do, is we tailor and craft a comprehensive financial plan for our clients so they don't feel uneasy in these times. Well, they might feel some uneasy, but at least they know they're focused on their plan, right? So we have a plan in place to handle these types of situations. And the key is if you're going to be in the market, you want to buy quality and you want to look long term. You don't want to be taking your income from the stock market. Does that make sense? You want your income to come from more stable portions of your portfolio. So that way when we have a big economic hiccup like we've had, you're not going to be as uncertain because you know your income is stable. So it's common to have intra-year declines in the S&P 500 and in the market. 29 out of 39 years, there's been an average drop of 13.9% in the S&P, but 29 of the 39 years still ended in positive territory. So we may end in positive territory for this year, but it is not corporate profits that's doing it. It is the government's policy actions that are propping up markets. That's not sustainable long term. What we're hoping for is that we get back to normal economic activity, then we have to focus on the debt. We can't keep this trajectory with our debt. We're over $26 trillion. Most of that is not owned by China or Japan. Most of it's owned by individuals around the world that hold treasury bonds. But the portion that they do own, they're not excited about getting less than 1% yield on it. So they want to do away with dollars, the world reserve currency, for that reason. So a couple of different things here is returns to the S&P. This is surprising. The S&P since the best days since January 3rd of 2000. If you invested in the S&P and held it through the end of last year, you made a 6.06 return, 6% return. But if you'd have missed just the 10 best days, just the 10 best days in the market, you'd only had a 2.44% return of that period of time. If you'd have missed the 20 best days in the market, you would have a 0.08% return. And if you go all the way to the right, if you'd have missed the 60 best days in the market since the year 2000, you'd be down 7%. Isn't that unbelievable? So that's why you don't want to try to jump in and out. With your market money, you want to buy quality and hold it long term. There has to be a reason to get out of the position. All right, any other questions before we wrap up? Yes,
So
ma'am.
realistically, what can you do about all that debt? And so, going out.
Well, we can't do anything. We have to get, see, the problem is it's both parties. Both parties have contributed to the debt, right? So we have to hold them accountable. We have to say, no more of this. We're not going to elect you if you increase the debt. See, they're worried about an election cycle. I'm worried about 10, 20 years from now when it gets to the point where the largest payment we have as a nation is the interest on our debt. We have a real problem when that happens. But politicians are not focused 10, 20 years down the road. They're focused, all right, I'm getting elected next year. Yeah, let's get some more spending in here for my constituents so I can appease my votes, right? That concerns me. We have to hold them accountable. That's the only thing we can do. Any other questions? So, in summary, we've had a rough year, and the outlook is a little uncertain moving forward. But what you want to look at is, are we seeing improvement? Are we seeing less government policy action and more private sector growth? That's what we have to see. And I believe if we have the freedom to make our own choices individually, as towns, as businesses, I think we will see a move back into the economy and higher growth. And again, the key is to have a financial plan in place so you know what to do during these times. You know where your income's coming from. You know what investments you own are the best things for you personally, tailored to you. So with that being said, that's our state of the market. If you have any other questions, I'll be around for a few minutes. And I think we're going to tee off and golf in just a few minutes. Thanks for coming. Appreciate it.